Hey everyone, this is Larry from wstrades.com. This podcast is about trading stocks and stock options. Any information in these podcasts should not be construed as advice. It's for educational and entertainment purposes only. We are not financial advisors. Hey everyone, it's Larry from wstrades.com. Today's podcast, we're going to talk about breakout trading. So first we're going to go over what breakout trading is, how to identify breakout patterns, and at the end I'm going to give you some tips and tricks to hopefully improve your breakout trading skills. So first off, what is breakout trading? So breakout trading is a style of trade that involves looking for levels or areas of a stock price that the price hasn't been able to move beyond after making several attempts at it. So the levels are support and resistance, and they act like barriers that prevent the price from going higher or lower. So when the price finally breaks through one of these levels, it's called a breakout. Some people call, including myself, I call a break below a level, I call that a breakdown, but it just kind of depends on who you're talking to. Breakout could mean either kind of a long or short scenario. So for example, let's say a stock's been trading between $50 and $60 for several weeks, forming a rectangle pattern on your chart. That's typically called a channel. So the $50 level is the support and the 60 is the resistance. As a breakout trader, you would wait for the price to either break above 60 or below 50 on high volume. And that would indicate that there's enough momentum and demand to push the price out of the range. If the price breaks above 60, then the trader would go long, expecting it to continue going higher. If it breaks below 50, then the trader would sell or go short, expecting it to keep on dumping. So when you take a breakout trade, you are making an assumption that the price level that's broken is going to become either new support or resistance. So in our example above or before, if the price broke above that $60 level, then you would make the assumption that it's going to start acting like support. So for me, that's one of the things that I like about taking breakout trades is it's kind of, there's no guesswork in where you're going to put your stops, because you make that assumption that, okay, it broke above 60, now 60 is going to act like support. Well, if it breaks below that, then your assumption was wrong and you're out of the trade. So how do we identify breakout patterns? Well, there's many types of breakout patterns that can form on a chart. Some of the most common ones are triangles, and you can listen to our podcast on triangles. I know it's kind of weird, discussing triangles on a podcast because, without the visuals, but basically these patterns are where the price makes lower highs and higher lows, and it looks like a wedge on your chart. So from the triangle podcast, that the triangles can be symmetrical, ascending or descending, and depending on the slope of the trend line. Triangles indicate that the price is consolidating before making a move in either direction. So in the triangle situation, you would wait for the price to break out of one of the legs of the triangle. Channels, like we talked about above or before, are where the price is moving within two basically parallel lines, forming a rectangle. So the channel can be horizontal, ascending or descending, kind of like the triangles. So it can either be sloping up or down, or just kind of pretty much flat straight across your chart. And channels are good because they indicate, whatever direction, if they're slanting up or down, it shows you the trend of the stock as well. So, if you're in a downward channel, overall trend is down. So if it makes a break above the top leg of that channel, then things may be reversing, and that might be a good time to go long. You have flags and pennants. These are patterns where the price makes a sharp move in one direction, and then it's followed by a brief consolidation period that forms a small rectangle, a flag, or a triangle, which would be a pennant. Flags and pennants indicate that the price is making a pause before resuming its previous trend. You got head and shoulders. This is a pattern where the price makes 3 peaks, with the middle peak being a little higher than the other two. The peaks form a shape that resembles a head and 2 shoulders. The neckline is drawn by connecting the two, or the lows of the 2 shoulders. Head and shoulders pattern usually indicates that the price is reversing from an uptrend to a downtrend, but that's not always the case. Cup and handle, this is another common one. This is a pattern where the price makes a U-shaped bottom followed by a smaller downward correction that forms the handle. So the rim of the cup is drawn by connecting the 2 highs of the U shape. The cup and handle pattern usually indicates that the price is reversing from a downtrend to an uptrend. So to identify these patterns, breakout traders use technical analysis tools such as trend lines, chart patterns, volume indicators, and candlestick patterns. These tools help you spot potential support and resistance levels, measure the strength of the price movement, and confirm the validity of the breakout. So a few tips and tricks for breakout trading are to use multiple time frames, such as the daily, hourly, or minute if you're trying to make really quick trades. Using multiple time frames can help you confirm a breakout on different levels of analysis, as well as spot potential fake outs or false breaks. Volume indicators, that's my favorite way of doing it, is a good way to measure how much interest and activity there is in the move for the breakout. So a high volume break indicates that there's strong demand or supply behind that price movement, while a low volume break would suggest that there's weak conviction or participation in the move. So volume indicators such as volume bars, on balance volume or OBV, volume average or volume weighted average price or the VWAP can help you gauge the volume behind the breakout. Or you can go over to the website WS Trades, and we have a BSP volume indicator that I use, that I made, that shows kind of the buying and selling of each candle. So you can see basically it's the buy sell pressure. You can see how much buying there was in a day, like it might be a green day, but there could have been a lot of selling in it. Like right now, at the time of recording this, I'm trying to go long. I believe it's SVT, and today they made a high volume break just above what was a resistance level, but they just did it by, I think it's like 10 cents or something really small. And today's volume was about 60% selling, but they were able to finish above that level. So I'm trying to go long with a pretty tight stop on it. But that's just one way you can use a volume indicator to kind of help you gauge whether you should be going long or short. Using stop loss orders. So stop loss orders are orders that automatically close your position if the price reaches a certain level. Stop loss orders can protect your capital and limit your losses in the case that the breakout fails or reverses. And a common way is to set the stop loss order just below the breakout level. I would say, if you're just, have a plan going into the trade, and if, you're willing to possibly give up 1%, then, find out whatever 1% is at and set your stop there. And, hopefully it doesn't hit that level and it continues moving, but, you always, that you're limiting your losses if this was a false break. Using a good risk to reward ratio is also key. So risk reward ratios is the ratio that compares how much you are risking versus how much you're expecting to make on a trade. Risk reward ratios can help you evaluate the potential profitability and viability of a trade, as well as guide you on how to size your position and the exit of your trade. So a common way to calculate the risk reward is to divide the difference between your entry price and your target price by the difference between your entry price and your stop loss price. For example, if you buy a stock at 50 with a target of 60 and a stop loss of 48, your risk reward ratio is 60 minus 50 divided by 50 minus 48, and that's a 5-to-1. So it means for every dollar you risk, you're expecting to make $5 in return. And typically that's way higher. I think the typical risk reward ratio is 2-to-3. So in conclusion, breakout trading is a popular and effective way of trading stocks and involves looking at levels or areas that a stock price has been unable to move beyond and entering a trade in the direction of the breakout. Breakout trading can offer many opportunities to capture large price movements and trends, but also requires careful analysis, discipline, and risk management. By using technical analysis tools, volume indicators, stop loss orders, trailing stops, and a good risk reward ratio, you can improve your breakout trading and increase your chances of success. So that's all I got for you guys today. Like I said, you can head over to the website and download the BSP indicator, which is the buy sell pressure, if you want to take a different look at how volume is calculated. Also, if you sign up for your free trial of the premium section, every day I update. I have a high volume breakout and breakdown scan that I post the results. And I had someone ask me, why don't just offer the indicators to people if they become premium members? And I have no problem with that, but why I post the results every day is because not a lot of people, well, I wouldn't say not a lot of people, but there are quite a few people that don't use Thinkswim, and that's what it's coded in. So this is a way that they don't have to get into, say, use Robinhood or anything like that. You don't have to switch over to Thinkswim, which I would. I would suggest it because it's a far superior, company and product, in my opinion. It's definitely, a learning curve you have to go through in order to, it's definitely not pretty. It's no frills. Robinhood, that's one of their big things, is it's a pretty application. You know what I mean? It's super easy to use and stuff. So there's a learning curve, but I say why I post the results instead of just selling the indicators is because not everyone uses Thinkswim. So anyways, you can head over to the website, check that out. 30-day free trial is still up, so just sign up for the forum and let me know, and I can give you that 30-day free trial.
Thanks for taking the time to listen to this episode of the WS Trades podcast. If you are not subscribed to this podcast, please subscribe. Also head over to YouTube and search for WS Trades. You'll find us there as well. We've got trading updates as we make our trades over there, and also educational videos so you can learn about different strategies within the stock market and options trading. And also please head over to wstrades.com. Thanks again.